Hello, and thank you for tuning in to the FI Mastery Podcast, where our focus is on providing tools, resources, and insights that empower driven individuals to secure their own path to financial independence. My name is Peter Donisanu, and today we're going to talk about a key component to securing financial independence, and that's income. Now, there's an old adage that goes, it's not about how much you make, but about how much you keep. And that's often applied to the concept of spending and saving prudently. But what if spending wisely and prudently managing your savings was just one part of securing your path to financial independence? Make no mistake, managing your cash flows is essential to mastering your path to financial independence. That's because without a firm grasp on this critical process, having the money you need to accomplish your life goals likely just won't happen. And that's why we recently reviewed methods for evaluating big ticket purchases and assessing your annual spending and savings decisions relative to your baseline goals so that you could identify other areas of opportunity for the coming year in previous episodes. But in this episode, we'll take a look at an often overlooked approach for putting more of your money to work in the present, and that's maximizing your income. Now, this subject will be relevant to you whether you're still in your earning years or already retired, because many individuals, whether their income comes from a paycheck or savings distribution, end up leaving thousands of dollars on the table each year. We'll also discuss some methods for paying yourself first and briefly cover your options when it comes to meeting near-term uneven cash flows and the order in which to contribute to your savings to build up that long-term nest egg. And by the end of this episode, you'll likely come away with a better understanding of the techniques to optimally fund your spending and savings goals for the year. So with that, let's dive into today's podcast. Maximizing your income is a critical component to securing your financial independence for the long term. Indeed, maximizing take-home pay is essential, but it's often overlooked task for many individuals. Why so? Well, because aside from asking for a raise or getting a new job, many individuals assume that there's little they can do to increase the amount of money they earn or they receive each month from their paycheck or their fixed savings. Now, the truth is that you can do a few things to keep more of the money that comes into your bank account. So what are some ways to increase your take-home cash flows? Well, one way to increase your income is to pay no more tax than necessary. And if you're still working, one of the most advantageous ways to minimize your taxes is to maximize your pre-tax retirement savings contributions to an employer-sponsored plan. That's because the money contributed to these accounts goes in on a pre-tax basis or before taxes are taken out of your take-home income. Now, compared to after-tax contributions, this approach maximizes the amount of money that can grow in your savings over the long term. For example, let's assume for a moment that your current employer-sponsored retirement account has $250,000 in it, and each year you contribute $20,000 to account on a pre-tax basis that earns 6% annually. At the end of 10 years, your portfolio could have grown to $730,000 when making these pre-tax contributions. Now let's also assume for a moment that you made those same contributions on an after-tax basis. Here we assume an effective tax rate of 30% and gives you the ability to contribute just $14,000 after Uncle Sam gets his fair share of your income. Assuming the same assumptions that we had before, by the end of 10 years, you'd likely have saved around $650,000. Now, that's a difference of around $80,000 just by making a simple choice to prioritize pre-tax versus after-tax contributions. And keep in mind that this difference could be even larger if your employer offers matching contributions to your employer-sponsored plan. Now, some individuals will set aside some money into their 401k or 403b and make additional contributions to their IRA hoping to get an extra tax break. The issue here is that if you're not maxing out your 401k before your IRA, you're likely only going to get a fraction of the tax benefit compared to prioritizing all of your contributions to be made on a pre-tax basis. This is especially the case for high-earning households as tax deductibility of IRA contributions are phased out over certain income limits. In contrast, 401k contributions are only limited by the annual amount that you can put in, making them a no-brainer choice when it comes to tax-advantaged savings options. Now, for those of you out there who are self-employed or running a small business and maxing out those IRA contributions, maybe now may be the time to consider setting up your own employer-sponsored retirement savings plan. Now, I know while the thought of setting up your own retirement plan can seem onerous, there are some straightforward options available that would allow you to make some tax-advantaged contributions. For example, if you're relying on an IRA to fund your retirement savings, then you're likely missing out on a big opportunity. There's options like solo 401ks, simple or SEP IRAs that allow you to contribute multiples more than what an IRA would be able to on a tax-advantaged basis and help reduce your overall tax burden. Now, deciding which one of these plans is right for you will come down to the structure and priorities of your business. And when it comes to the administration of these plans, you have to know that many custodians today make it easy to manage a retirement plan for your business without having to deal with all the administrative red tape that you may be worried about. Another way to increase your take-home pay is to adjust how much tax is withheld from your paycheck each pay period. This approach may be relevant to you if you receive a tax refund from one year to the next. Now remember, while a refund may seem like a windfall when you receive it, at the end of the day, it's an interest-free loan that you're making to Uncle Sam throughout the course of the year. So to this point, to reduce your odds of a tax refund and increase the amount of cash available to you each pay period, you'll want to adjust your withholding exemptions through your Form W-4. By lowering your exemptions, you can reduce how much money is withheld from your paycheck, but before you go out and start making those changes, go out and check out the IRS's tax withholding estimator. This tool will help you get a gauge of the ideal number of withholdings to elect in your W-4. And when you're ready to make those adjustments, be sure to reach out to your HR department or your payroll service provider to make the necessary adjustments. Now, for you tech professionals out there, you'll likely receive incentive compensation in the form of stock options or restricted stocks as part of your total pay package this year. However, many tech professionals don't fully understand the value and potential of their equity compensation benefits, which can result in missed financial opportunities. So if you're the recipient of equity compensation, what are some things you can watch out for to maximize your income? Well, first, you need to understand that equity comp is tied to your company's overall performance and can increase in value over your time as your company grows and its stock price appreciates. If you're a tech professional who receives equity compensation, but you're doing nothing to pay attention to the details of your equity award, you may be missing out on an opportunity to sell your stock at a high price ahead of periods of time where markets begin to sell off. Second, there may be restrictions or deadlines associated with equity compensation you receive that you need to be aware of. For example, RSUs typically vest over a period of time and may be subject to forfeiture if you leave your company before your vesting period is over. And stock options like ISOs may have an expiration date, meaning they become worthless after a period of time, so staying on top of these vesting periods is essential. Next, you'll need to understand the tax implications of exercising stock options or selling RSUs, such as the ordinary income tax rate, or the difference between the exercise price and the stock price at the time of exercise, as well as potential capital gains on the sale of your stock. Now, amidst all these moving pieces, it's easy to leave your stock word aside and do nothing about it. That's why you'll likely benefit from last month's discussion on equity compensation housekeeping. You can find resources in the 5 Mastery Journey to review best practices for managing your awards, but at the very least, get to know your equity award and make sure that you're taking advantage of opportunities where they're available. Another effective way to maximize your income is to pay for regular expenses on a pre-tax basis. Now, a couple of tools available through your employer may include health savings accounts or HSAs and flexible spending accounts or FSAs. Now, if you have a high deductible health plan, for example, HSAs allow you to make pre-tax contributions that can be later used to pay for medical expenses. This type of account also has an investment component built into it that allows your savings to grow over the long term. Now, another way to spend on a pre-tax basis is to utilize that flexible spending account or that FSA. Now, these types of accounts are typically those use it or lose it types of accounts, and this means that any contribution you make during the course of the year must be spent within that year or you'll lose the money at the end of the year. Even so, these types of accounts still offer some advantages. For example, let's assume for a moment that you spend $10,000 per year on childcare expenses. If your employer offers a dependent care FSA and a household contributes $5,000 annually to this account on a pre-tax basis, assuming that you have an effective tax rate of 24%, that $5,000 gives you a $1,500 annual equivalent savings on that contribution towards those childcare expenses. So that's something to consider there as well. Now, another way to keep more money in your pocket is to evaluate how you're paying for life insurance. Now, whether you have a family or are just getting started, life insurance is often a cheap way to transfer financial risk should something happen to you. And if you have an individual life insurance policy but are not taking advantage of your employer's group policy, you may be paying for more on that individual policy than what's available to you through your employer's benefit. Finally, another way to maximize your income is to consider asking your employer or your clients, if you're self-employed, for more money. This may include having an awkward conversation, but could end up netting you a few extra $1,000s per year. This approach could involve either asking for a raise or negotiating an off-cycle increase in your incentive comp, such as a bonus or an off-cycle equity grant. And if you're self-employed, now may be the time to evaluate the fees charged to your clients. Given the recent cost of living increases, now may be an opportune time to raise your prices to reflect not just your value of the services, but also your rising overhead cost. When taken as a whole, increasing the take-home component of your cash flows can help ensure that you achieve your spending and savings goals for the year. While earning more money is certainly one way to accomplish this goals, being more tax efficient with your cash flows is a more controllable approach to bring in home more money from one pay period to the next. Now, if you've already achieved your financial independence goals and are living off retirement savings, then finding ways to maximize your take-home salary may seem less relevant to you. Even so, while fine-tuning your earnings ability was a key consideration during your accumulation years, focusing on the income-producing capabilities of your savings nest egg will be essential to staying strong financially throughout retirement. Now, while some rules of thumb will guide you on how much you should safely withdraw from your portfolio from one year to the next, the fact is that a disciplined investment process will be essential to preserving the value of your potential lifetime retirement income. To this end, there are a few approaches that you should consider when it comes to maximizing your potential retirement income generated by your investment portfolio this year, and that's your investment strategy and your cash management strategy. So let's take a look at ways how you can maximize the income producing capabilities of your retirement savings. To start, one of the most important steps you can take to maximize the sustainable income from your investment portfolio is to diversify your investments. To do this, ensure that you're spreading your assets across various types of investments, including stocks and bonds, U.S. and international assets. This approach will help you reduce your portfolio's overall risk and ensure a reliable income stream throughout your retirement. Indeed, setting the appropriate mix of stocks and bonds, U.S. and international assets is essential for preserving the income-producing capabilities of your retirement savings. And the degree to which you allocate between various asset classes influences your investment rate of return. For example, a larger allocation to historically riskier assets could generate a higher rate of return from your portfolio compared to allocations to typically conservative assets like government bonds. So how much should you contribute to each mix? Well, start by evaluating your risk tolerance by preparing your investment policy statement so that you can find the right mix for you. This approach indeed will be essential to crafting to and sticking to a disciplined investment process in the years ahead. Next, consider allocating your savings to passive investment strategies such as exchange-traded funds. These vehicles are often lower cost and easier to manage than actively managed portfolios. They can help you maximize the income from your investment portfolio by reducing the amount of money you need to spend on fees and expenses from one year to the next. Another way to maximize your income from your investment portfolio involves understanding how income is taxed. For example, capital gains, dividends, and interest income can all be taxed at different rates. Therefore, if your portfolio composition or the allocation to a particular security or asset class is heavily weighted towards taxable income, then you could be giving away more of your money to Uncle Sam than is necessary. Therefore, one way to produce tax-efficient income for your portfolio is through munis. Municipal bonds, also known as munis, are debt securities issued by state or local governments to finance public projects such as infrastructure, schools, and hospitals. In a retirement investment portfolio, muni bonds can serve as a source of stable, tax-free income. And since the interest earned on munis is often exempt from federal and state taxes, they can be especially attractive for individuals in high tax brackets who are looking for ways to reduce their tax liability. Munis can also add diversification to a portfolio as their performance is often uncorrelated with stocks and other bonds. However, it's essential to consider the credit risk of the issuer as well as the market risks associated with bonds before adding munis to a retirement portfolio. Another way to increase your retirement income is to reduce how much future tax you're going to pay to Uncle Sam. To achieve this outcome, you'll want to evaluate the tax efficiency of your investment portfolio. If you expect your taxable income to rise after retirement, especially when required minimum distributions or RMDs kick in, consider ways to reduce your future tax liability. In some cases, evaluating the benefit of a Roth conversion might make sense. Now, a Roth conversion is the process of moving money from a traditional IRA to a Roth IRA. By converting a traditional IRA to a Roth IRA, a retired individual may be able to reduce their future tax liabilities by establishing a source of tax-free withdrawals, reducing or eliminating RMDs, and generally putting this individual into a lower overall tax bracket. Another way to maximize income over the long term is to potentially mitigate near-term losses in your portfolio through regular rebalancing. Now, as markets fluctuate, your portfolio asset allocation may change, which can impact the sustainable withdrawal rate that you can generate from your investments. To avoid this outcome, consider rebalancing your portfolio on a regular basis to ensure that your desired asset allocation is maintained from one quarter to the next. And finally, another critical component to preserving your spending ability when drawing down assets is having an adequate cash management plan in place. Now, this means having enough cash on hand within your portfolio to cover 12 to 18 months worth of living expenses. So why would a retired individual want to have so much cash on hand within their portfolio? Well, after a year like we had in 2022 in the markets, the last thing you want to be doing is selling securities when the markets are going down in order to cover your living expenses. Either way, finding ways to maximize your income from your investment portfolio is vital to ensuring that you don't go broke in your post-employment years. Addressing this concern often begins by having an investment strategy and mix of assets that fit your overall risk tolerance, goals, and objectives. Then allocating to low-cost, tax-efficient investments likely will ensure that you're keeping more of your money by paying only what's necessary. And finally, having a cash management plan in place may allow you to weather the ups and downs in the markets without having to sell securities at an inopportune time. So now that we've discussed ways to maximize your income, whether that's from earned income or retirement income, let's take a few minutes to explore the concept of paying yourself first. So what do we mean when we say pay yourself first here? Well, what we're talking about is setting aside a portion of your monthly income for savings and investments before paying bills and spending on other expenses. This approach may help you prioritize your financial goals and build wealth over the long term. Now, paying yourself first includes funding your cash management or emergency savings fund and allocating your money to suitable financial accounts. Now, a cash management plan or an emergency savings fund is an essential component to a solid financial plan. At its core, it's effectively a savings account that's set aside for unexpected expenses such as car repairs, medical bills, job losses, or uneven income. Indeed, having an emergency savings fund can provide peace of mind and financial security in times of crisis or uncertainty. So how much should you have saved in your emergency savings fund? Well, one rule of thumb is saving between 3 to 6 months of your household living expenses. Now, depending on your situation, your financial planner will define what this number should be for your specific financial situation. Either way, know how much money you should have in that savings account and commit to funding that goal. In terms of where to put aside this emergency savings fund, you can consider a high-yield savings account, a CD, or a Roth IRA. For example, a high-yield savings account is a type of savings account that offers a higher interest rate than a traditional savings account. And this means that your money will grow faster and that you'll earn more interest over time. The only caveat here is to make sure that you're working with a reputable bank and not just fly-by-night bank that offers what seems to be an incredible savings rate. So that's something to watch for there. A certificate of deposit or a CD is a type of savings account that allows you to deposit money for a fixed period, typically between 3 months to 5 years. Now, CDs usually offer a higher interest rate than a savings account, but they also have penalties if you take the money out sooner than the period that you've signed up for. So that's something to watch for there. And a Roth IRA, we've talked about Roth IRAs before, is a type of retirement account that lets you invest money on an after-tax basis and gives you the ability to withdraw those funds in retirement on a tax-free basis once you've reached the age of 59 and a half. Now, if you're young and in a lower tax bracket, this may be a good option for you as a emergency savings vehicle because you do have the option under certain circumstances to tap into your Roth IRA to pull those funds back out should you need them in a qualifying event or in an emergency. Now that we've talked about ways to fund your emergency savings, the big question here is where should your money go to fund those long-term savings goals so that you can maximize your income in retirement and minimize your taxes. Now, make no mistake, it can be confusing to know which account to contribute to first and in which order. But as you begin paying yourself, you should contribute to various retirement and taxable investment accounts that give you the most significant tax bang for your buck. Now, the first step in the savings plan should be to take full advantage of your employer-sponsored retirement plans such as a 401k or 403b. Again, these plans offer significant tax benefits, including the ability to contribute pre-tax dollars. Additionally, many employers provide matching contributions, which is free money, or it's a 100% return on some of your retirement contributions. After you've maximized your contributions to your employer-sponsored retirement plan, you should contribute to an individual IRA account. Now, a traditional IRA contribution is tax deductible and the money grows tax-free until withdrawal. Again, like we mentioned before, a Roth IRA, those contributions are made on an after-tax basis, but the withdrawals in retirement are typically tax-free. And once you've maximized your contributions to your employer-sponsored plan and your IRAs, you can begin contributing to a taxable investment account. Now, while these investment accounts are not tax advantaged, the benefit of these accounts is that you can withdraw money at any time without penalty. Now, after you've made these regular contributions to the previous accounts, if you're enrolled in a high deductible health plan, you may be able to open an HSA, and the benefit of these accounts is that the contributions to the HSAs are typically made on a pre-tax basis, and your money grows tax-free, and the withdrawals for qualified medical expenses are also tax-free. So that's something to consider when we're thinking about planning for those medical expenses over the long term, especially in retirement. And finally, if you have children, consider contributing to a college savings plan like a 529. These plans offer some tax benefits, including the ability to take tax-free withdrawals for qualified education expenses. Now, it's important to note that some of these accounts have contribution limits and that it's essential to check the limits and rules to avoid penalties as you're making these contributions. Additionally, you should consider your overall financial situation and your goals when deciding on how much to contribute to each account. Ultimately, the most important thing is to find an account that works for you, that you're comfortable with, and that you can easily access in case of emergency. And setting up that savings plan, tracking your spending, and cutting back on unnecessary expenses are all effective ways to build up or to fund your emergency savings plan. But remember, it's never too late to start your emergency savings fund, which is necessary to achieving financial stability. And by taking a step back and thinking about everything we've talked about here today, like maximizing pre-tax retirement contributions, creating a self-employment retirement plan, adjusting your W-4, you can minimize your tax burden and in many cases, maximize your income. And the result is more money in your pockets and a secure financial future. But it doesn't stop there. Maximizing the income from your investment portfolio is also crucial for a strong and sustainable retirement. This includes diversifying your investments across stocks, bonds, U.S. and international assets, and allocating your savings to passive investment strategies like index funds. Doing these things can reduce overall portfolio risk and again, increase your retirement income. And by finding tax-efficient sources of income and reducing future tax liabilities, you can take control of your financial future. But doing this work starts with a disciplined investment process and a deep understanding of the tax implications in your portfolio and careful consideration of all the factors that impact your retirement income. But with the right strategies in place, financial independence is well within your reach. And finally, the key to maximizing your income is to avoid letting it be diverted to the inevitable financial setback. By establishing a solid cash management or emergency fund, you can secure your financial stability in times of crisis or uncertainty. Whether that's through a high-yield savings account, CD, a Roth IRA, or other options, the key is to evaluate your emergency savings target, choose the right savings vehicle, and contribute to it regularly. Now, these temporary sacrifices may seem onerous, but the peace of mind and financial security will likely last a lifetime. Indeed, taking these steps will not only allow you to maximize your income, but they'll also take you one step closer to becoming the master of your own financial independence journey. Well, that's it for now. Thank you for taking the time to listen to the FI Mastery podcast. To learn more about our research, visit us at fimastery.com or email your questions to questions@franklinmadisonadvisors.com. Until next time, I'm Peter Donisanu, wishing you and yours abundant health and prosperity.
FI Mastery Podcast is brought to you by Franklin Madison Advisors, Inc. Franklin Madison Advisors is a registered investment advisor firm with its registration and principal place of business in the Commonwealth of Pennsylvania. Registration of an investment advisor does not imply a certain level of skill or training. This commentary and forecasts are limited to the dissemination of general information pertaining to Franklin Madison Advisors' investment advisory services and general economic and market conditions and are subject to change without notice. The information shared today is not intended to be personal, legal, investment, or tax advice, or a solicitation to buy or sell any security or engage in a particular investment strategy. For additional information about Franklin Madison Advisors, including fees and services, please contact Franklin Madison Advisors or refer to the Investment Advisor public disclosures.